And then, who are the people that lose their money? Usually the people that are conservative, because they want a guaranteed fixed return. And anybody who calls them up and says, I will give you a guaranteed fixed return, will get their money. They don't ever ask, who's guaranteeing it. Bonsai schemes, they're all built on the same mentality. I will promise to make you 12% per year. And they'll send it to you for a couple of months, and then boom, it all goes away. I've had a couple of 85-year-old German clients that come to mind, who she had never bought anything except stock her whole life. And at the time I knew her, and this was almost 20 years ago, she was collecting $60,000 a year in dividends. So you have a feel idea how many dollars she actually had in stock. But you could never call her up on the phone and say, hey, I got this deal. If it wasn't blue chip and she understood it, there wasn't going to be a dime. So I've never yet met an investor, a true investor, understanding risk and taking risk, that lost money to Bonsai schemes and people that are fly-by-night operations. Because they understand the ability to evaluate risk, and if somebody says guaranteed 10%, no way in heck. 12%, no way. There's almost no investment out there that's guaranteed over 5%. So if anybody comes to you and guarantees more than 5%, from my perspective, it's a fly-by-night operation. And you shouldn't even give it some time. So we're going to look at long-term investments. I think as an individual, trying to keep costs down to maximize return, and unless you're really a stock junkie, in other words, you like to watch the stock market, you like to follow stocks and stuff like that, mutual funds is the way to go. And the conservative side of the mutual funds is the index. In other words, you buy an index cap growth mutual fund, it's going to match the S&P 500 exactly whatever the S&P 500 is. You buy a mid cap, it's going to exercise something that's similar to that size. So, and I like Vanguard because they have the lowest expense ratios in the industry. So they take very little money out to cover their expenses. So rule of 72, and this is to help you, you can get your calculator out and do even more sophisticated stuff. But if you're just trying to figure out, what do I need to do to double my money? Rule of 72 says you take 72, you divide it by the rate of return that you're going to earn, and that will give you the number of years that it will double. So if we got 72 divided by 10%, it should double in 7.2 years. If you got 8%, it should double in 6 years. No, 8 is 9 years. I knew my math.
You've got it up there on the screen.
Oh, okay. And then if it's 12%, it's going to double in 6 years. So that helps you understand. Now the question is, why is that important? Disregard these next two slides. I don't know how they got in there. That was a mistake on my part. So here we're comparing 8 to 12% return. So if it doubles every 6 years under 12% and every 9 years under 8%, so where are we about 24 years from now? Well, the 12%, we've got 150,000 versus only 63,000 at 8%. So this is more dramatic so you can see the difference, but every 1% interest or more you can squeeze out of your investments is going to have huge long-term benefits when you're looking at retirement, which also means that if you're investing in a mutual fund that has a 0.12% expense ratio versus one that's got a 1.12%, that's a 1% cost that if you don't have to pay, it's going to pile up in the amount of money you have 24 years later. So unless you can find that very few managers that can perform above the average all the time. So what are the long-term returns? Now this is 1926 till today, and that includes before the stock collapse in 29, and all the ones since then, 87, 207, whatever. Inflation's been about 2.99%, so 3% is a ballpark that's been good for many, many years. US 30-day treasuries, that is money that's invested for 30 days, has over that time period paid out 3.52%, which is just over in inflation rate. And if you looked at treasuries today, they're way down less than 2%. Long-term bonds, a little more growth oriented, which has always been the model of where you move your money when you were conservative, has been about 6%. Large cap companies, about 12% during that time period, and small caps about 16.6%. Now the small caps, since 1972, have done way more than that even. Maybe it's the nature of the environment we live in now. Many companies start out like a Microsoft and Google. They start out as small caps on the NASDAQ, and then they take off and they become big. But they're still considered small cap from that's their beginning. And there's a point they grow before they actually become moved out of that category, and they make most of their growth during that time. So these are the long term. So I'm a big advocate of investing in growth. Does that mean I'm looking at a portfolio to earn 16%? No. My goal is 10%. My goal on my long-term investments is 10%. That's all I want to earn. And if I can average that, and I have since the last 10 years, even though the declines we've had, have been 12%. So I'm ahead of where I want to be. Last year was a good year, super year. Here are some stock. United Health, 38%. Target didn't do so good, but Best Buy was up 238%. But they dropped 30% in one day this week. 3M went up 50%. But you got to understand that for 10 years, 3M didn't do anything. So, individual stocks has potential for high growth, but it doesn't necessarily guarantee it. I prefer to invest with a manager of a mutual fund that's managing 100 to 200 stocks, buying and selling periodically. I feel longer that I can maintain a larger return long term. So here were the indexes. If you just invested in the indexes last year, yes, the Dow 30 was up 26.5%, S&P 500 up 29.6%, NASDAQ was up, small caps, 38%. Russell 2000 is the best 2,000 of the small caps, that's 37%. Tokyo, 56%, Frankfurt, 25%, London, 14%. So I'm a big advocate in having some money overseas, and I wouldn't necessarily pick and choose countries. There's 3 categories that you might consider. One is Europe, one is the Far East, and one would be emerging countries. So the emerging countries one is that if you like the roller coaster, it's going to be all over the place. But there are also some great potential, and it's not a part, and not a bad place to have a small part of your portfolio. How much should you have overseas? Conservative people think 5 or 6% is all you should. I'm comfortable at a third of the money. Because you got to understand that all the markets in the world, the U.S. stock market is not, we're the biggest stock market, but we're not, there's a small fraction of the total world. So here are some mutual fund category growth for 1 year, 5 year, and 10 year. You'll see that all the indexes for 10 years, because that goes back to 2013 or 2003, have been less than 10%. So, if you're really concerned about things going up and down, you're not going to be guaranteed going to average 10 all the time. On the other hand, if you had bailed out, several of my clients did in 2007, 2008, the 5 years from that time period, you see almost all of them are 15% or higher. So they lost out. If you divide by 20 into 7.2, you get a little over 3 years. Most of these accounts doubled in 3 years. So being in the market after the collapse, you needed to do that in order to be positive in the long run. So I'm a big advocate of being totally invested all the time and check your portfolio once a year. No. Everybody's different with that. Now, stock versus mutual funds. If you understand that mutual funds, the manager is buying and selling stock all the time, they're required by law to distribute out 95% of all dividends and capital gains every year. So if I own a mutual fund that did great this year and went up 20%, but the manager actually sold and distributed out 25%, I've got to pay tax on that 25% of gain. If it's inside a retirement plan, it doesn't matter. It's all going to become ordinary income anyway, so owning mutual funds inside a retirement plan makes a lot of sense. On the other hand, if you own stock outside the retirement plan, if you bought it for $1,000, it goes down to $500, you can actually sell it and use that $500 loss against the gain in some other portfolio. So people that own stock outside of retirement plans should, once a year, sit down and evaluate the stock they own. And if it's one they want to continue to hold, fine. If it's one that's done poorly and they don't necessarily want to hold it, they should then sell it and reinvest in something that will do better, and they can probably save some taxes at the same time. Stock is also a better charitable tool because a mutual fund, if you're paying the tax on the gain, 95% of the gain every year, your basis in that fund is going to be very close to what the value is. So if you gift it, you're really not saving yourself much on the capital gains, the deferred capital gains. On the other hand, if I buy stock for $10,000 or for $1,000, it's now worth $10,000, and I gift it, I avoid $9,000 of capital gains because the company or the nonprofit, which does not pay tax, is receiving that. The rules that apply to a gift to charity is the same rules that apply as a gift to children. That when you gift your children stock or another relative, you gift them your basis. So if I had that same $10,000, I paid $1,000 for it, I give it to Neil. Neil sells it, he's got to pay capital gains at $9,000. So whoever receives it is the one that's going to be obligated for the tax, and if it's a nonprofit, of course, it is for tax. A single stock can be more risky, but it can also be more exciting for those who like excitement.